We made that possible, right? You can go onto your platform today on your mobile, go to smartcard.ae, create an account, 5 clicks, and you can own a property in Dubai. That is amazing.
It is. It is. Definitely disruptive, I would say.
Yeah, so the concept is extremely simple, right? So think about it. What we do is we take a real estate property and literally break it down into smaller chunks, right? So take a $1 million dirham property and think of it, we're breaking it down into 100 slots of 10,000 dirhams each. And then what that does, it allows people to buy as many slots as possible of 10,000 dirhams, and then collectively people will own that property and benefit from the returns generated from that property, whether it be rental income or any capital appreciation in the future when we exit the property. So it allows people to get onto the property ladder with small amounts of money and without necessarily taking a concentration risk by putting $1 million dirhams into one single asset, where they can take whatever investable capital they have in real estate and spread it across multiple properties. When we first started our vision, what was very important for us from day one was to ensure we gave people that comfort, that confidence that they are putting money into a platform that is well regulated, well structured, where my investment is protected. So one of the first things we did was got ourselves financially regulated. We didn't need to be, but that was a conscious decision we made to ensure people are getting a good value product. So the beauty is in the structure of how these things are set up. So we comply with the DLD laws and regulations, and as well as being set up here in the DIFC, we leverage the MOU that is signed between the DIFC and the land department. What's really encouraging for me from an offline perspective, it's still booming, right? So there's huge appetite from the investor community to get on the real estate ladder. And for many, that's the only affordable way to get on the property market, with all the generous payment plans that a lot of the developers are offering from when it comes to off-plan. But what we try to educate to investors is that's great that you're getting ability to get on there, but you have to make sure that your risk is calculated accordingly, because not to say off-plan is not a good investment opportunity, but it carries more risk than a ready property. So yes, it's affordable for you on a sort of a payment plan and a post-over payment plan, but you have to realize that you'll be paying capital into a property for many years before any capital comes back to you. And for you to really make money from a return perspective, time value of money, that property price has to appreciate substantially for you to come out on top.
Right.
Whereas we're offering the alternative of bringing that same level of affordability in today, right now. You can invest today and start earning money tomorrow. So what that does is protects you. It gives you that downside protection because you have a property that's generating you income, regardless what happens to the market. As long as you're not selling that property, you're not incurring a loss. It's just a paper loss. As long as you're getting paid, you're fine, right? And the fact that you've only put in a small amount of money, you don't have any payment commitments and so forth, you can be patient and sustain that investment, and you won't necessarily have to take that property appreciate tremendously for you to make money, because the chunk of your returns are coming from the income that is being generated today. And cash in hand today is a lot more valuable cash in the future that might or might not come.
Of course.
Yeah, so real estate should be taken as a long-term investment. And what's really important is, well, when we first started this concept, the idea, there was two things we were trying to solve, right? One is giving people accessibility, but what was also important is giving people accessibility in a fashion where they can sustain their investment through cycles. So if you think from that perspective, in terms of where the Dubai real estate cycle is, if you look at historically, the real estate cycle in Dubai averages between 5 to 7 years, and we are probably at the back end of that cycle of the bottoming out, where the next cycle uptick could take another 4 or 5 years. So what we are recommending investors who are coming onto our platform, that you should have at least a horizon of 3+ years to hold a property. We have a suggested period of 5-year holding period. And what's important is we focus on properties that are good income generating properties, so you can get paid well while you wait for the next uptick cycle to exit at a premium to what you had bought the property at. So your overall return on your investment would be quite attractive. A few key differences I would like to highlight between us and a REIT is the level of transparency and control on your investment decision. So in our platform, you know exactly where you're allocating your capital, meaning you decide, I want to put 20,000 dirhams in that particular marina apartment in that building, as opposed to in a different asset. Whereas in a REIT, you're giving money to a fund manager who's making decision on your behalf in terms of what their capital is being allocated. So you have more control in terms of your investment decision, your transparency, exactly what you own and how you're generating your income. And what that does is also cost structures are quite different, right? So with REITs, the infrastructure costs are quite high. In terms of you have to pay the fund manager, you have to pay the fund administrator, facility managers, and so forth. So when you look at the gross yield and what the net yield is, there's a big haircut. Anywhere between 60 to 40% haircut in terms of what the gross and the net yield is. In our situation, it's much leaner. So the only thing you're paying, you obviously have to pay service charges for your property, you have to pay a property management fee, and you're only paying additional administration fee that we charge on an annual basis. So from gross to net yield, it's a lot more leaner from that perspective. You get better returns from that perspective. You're controlling your decision. The other thing I would say is diversification. So if you look at it purely from a portfolio perspective, if you have a portfolio of stocks and bonds, and you have REITs are fairly correlated with the stock market, meaning if the stock market goes up and down, the REITs tend to follow in a similar direction, whereas direct real estate, meaning things you can point fingers to that I own a property, doesn't necessarily move at the same direction the stock market. So it gives you better diversification, rather protection against your wider portfolio. And many people just don't have enough money to buy shares, stocks, and then go buy an apartment or 2 apartments or 3 apartments. By our platform, what it does, it allows you, even if you have $100,000 to spend, you can spend invest $40,000 in stocks, $20,000 in bonds, and remaining $40,000 in diverse real estate portfolio that is direct real estate, gives you better diversification. So those are some of the major differences. The advantage that REIT has over our platform is probably liquidity in terms of it's traded, so you can easily get in, get out. But that comes at a cost, right? Because anything that's liquid, you have to pay a price for it.